Okay, thank you very much. Let me begin by saying it's my honor to be back here at the Swedish Economic Association. I've been here before. I'm a recidivist in that sense, but we're going to talk some enforcement language, and recidivist is one of my favorite concepts. Okay, it is also right now 3 a.m. in New York City, which I left yesterday, and in another half an hour I'll start really warming up, but move with me slowly and we'll pick up the pace as I go. I have tried to customize this talk to a Scandinavian audience. There's always a danger in doing that because while you think you're being provocative, they think you're being insulting. But I am going to try to make some statements that position Scandinavia because it does stand out on one polar side of the world. And now we'll see if these slides actually work. By the way, this is a New Yorker cartoon, and it shows you the recurrent dynamic in white-collar criminal prosecutions. The defendant who's looking sort of abashed is sitting there, and his lawyer is saying, "Your Honor, my client now realizes that his actions in the Unitech buyout and takeover and his transfers of funds to Swiss bank accounts were dreadfully immature." And that's how a lot of white-collar prosecutions end up. Suddenly he's just a guy who's contrite and gets off with modest sentence. Now, let's talk about Scandinavia, and you are distinctive. This is called the Corruption Perceptions Index, published regularly by a group called Transparency International, which is a not-for-profit organization related to lots of other good governance groups, and they come up, whatever criteria they're using, with their list of the most transparent, least corrupt countries. And see if you notice a common denominator there. We start with New Zealand, and we go to Denmark, Finland, Norway, Switzerland, Singapore, and Sweden. And your all reaction will be, why is Norway ahead of Sweden? We're better than them. That's not of interest to me. I'm interested in the fact that Scandinavia absolutely dominates this list. And actually, from my distant perspective, the Netherlands is pretty close, Estonia is pretty close, something about Northern Europe. In fact, if you go back to World War I and the beginning of anti-corruption campaigns in the period from 1900 to 1914 or so, Germany led the list. There's something about Northern Europe. And more generally, today, when social scientists look at this, and they've written a little bit about this, they emphasize the following things. What unites most of these countries? Well, they are small, compact, and socially homogeneous. Now, I'm not saying Sweden is small, but the others, Switzerland, Singapore, Luxembourg, they're pretty small. Socially homogeneous, I think that's right. There are some exceptions, but having one culture, one set of norms, that probably makes you more transparent and at least less corrupt, all right? So in Scandinavia today, and this may be a disability, a limitation, you do not see rampant corruption. And that may lead you into the fallacy, the deep, deep fallacy of thinking that law compliance is natural. I don't think that is true. I've had this debate for a decade or more with British regulators. British regulators tend to spend their enforcement budget going around to investment banks, communicating what they want investment banks to do and not do. And they make it very clear what they want. On the other hand, there are obscene profits involved in insider trading. And what happens? Does the statement of here's the norms we expect gentlemen to comply with, or the prospect of obscene profits motivates you more? We've recently had some scandals in the UK involving LIBOR and Euribor and others, suggesting that beneath the surface, obscene profits still motivates people a lot, and those profits are growing today. So the real world of markets, even though it may be hidden and not transparent, is probably more corrupt, sordid, and crooked than you tend to realize here in clean, honest Scandinavia. This is at the point where I may get beginning to be abrasive with you. But as a result, if you believe that law compliance is natural, that people tend to internalize the sanctions that are in their laws, you may undervalue enforcement and focus simply on rule definition. This is also the difference between lawyers and economists. Economists are very concerned about over-enforcement and chilling desirable activities, and lawyers are very conscious of how hard it is to convict the truly corrupt who've hidden a few of their tracks. Okay, we'll come back to that dispute again. Outside of Scandinavia, law compliance cannot be assumed, should not be assumed, and defining the optimal legal rule involves a consideration that I don't hear much discussed by economists. That is, what can be enforced feasibly. Because if you have an infeasible rule, it's not going to work very well. And eventually the enforcers are going to abandon it because they don't like losing. It embarrasses them. So, bottom line for this opening statement, law of prescription, the search for the optimal legal rule, needs to be merged to some degree, a debatable degree to be sure, with enforcement analysis. What is it possible to enforce? And that involves two different cultures speaking to each other. I'll come back and end with the difference in human capital between enforcers and regulators, because they've had different careers and different perspectives. Now, is the world getting better? Here's another one of these interesting studies that you can read different ways. According to the World Bank's 2017, there is not yet a 2018 rating, to their 2017 Control of Corruption ratings, over the past 20 years, 22 nations progressed significantly, and 3 cheers for those 22. Unfortunately, 25 nations regressed significantly. It's not clear that the battle is being won. 25 down, 22 up. That's counting them all equally, and that's probably wrong, but I only have the data they give me. The glass, then, in terms of improvement from corruption, is both half full and half empty and going in both directions at once. Still, and here's the one glimmer of optimism I'm going to offer before I plunge into talking about manipulation. On every continent, there are outlier countries that for strange, maybe idiosyncratic reasons, are behaving much more honestly than the countries around them. It's not that one continent-wide culture dominates the world. We have really quite remarkable differences among similarly situated countries. Let's talk about who the clean are. There are a variety of studies and reports that say in Africa, which may have the highest level of bribery and corruption, there are 2 countries, Botswana and Mauritius, which appear to be quite honest. Corruption is strange. There have been political leaders there who forced through a strong policy. In Asia, well, historically, Singapore was always the toughest, the least corrupt. I've been in Singapore, you don't dare drop a tissue paper on the sidewalk. You could get arrested for that. Okay. By the way, they had the death penalty for drug use, too, so you have to be very law compliant in Singapore. But South Korea, the prime minister was recently arrested and convicted. No one is above the law in South Korea. Taiwan, and China is changing. China has a major anti-corruption program. It's connected with party struggles. I don't predict the future, but there are real changes going on, and graft in China has become very dangerous. South America, for reasons that I can't fully explain, Chile and Costa Rica have long been quite honest and quite democratic, totally different, say, than Argentina and Brazil. Why? Long discussion I don't mean to get into, but it's possible that countries can be very different. And in North America, we have Canada that can look down both literally and figuratively at its countries to the south, which are far less law compliant. So for some reason, Canada is more like the UK than it is like the US in this regard. So optimism is possible, but not inevitable. Just have a hold on a glimmer of optimism, but don't assume it. Okay. Now, how is financial supervision different? So far, I've taken some of your time and said not a word about financial supervision. Of course, I recognize that financial regulation is not only concerned with fraud. Indeed, if you ask economists and give them their top 10 concerns, fraud might not make that list. But regulation of financial markets has other concerns: systemic risk, excessive volatility, maintenance of efficient markets, enabling firms to raise capital, lowering the cost of capital. In the US, we always list that as one of the 3 goals of the SEC. You have to say this if you're in politics in the United States. The goals of the SEC are consumer protection, fair and orderly markets, and allowing companies to raise capital efficiently at the lowest possible cost. And all those things, of course, are in considerable tension, but you have to list all 3 and say they're always what I'm concerned with. Okay. Now, the preservation of fair, manipulated markets can no longer be achieved on a simply domestic basis. That's the assertion I'm going to make over and over. If it could, maybe Scandinavia could ignore the sordid world beyond its shores. But it can't. Basically, my claim that I'm going to use several anecdotes, illustrations to discuss today, is that financial markets and their regulation has to be increasingly global in character or it will fail. And as a result, your markets are subject to fraud and manipulation from abroad, and particularly from fairly dark corners of the world. The new entrepreneurial fraudsters, and I want to use that term again, the new fraudsters are very entrepreneurial. They'll learn some tactic in one country and they'll move it into Europe, and we'll see some examples of that. They can hide in dark corners and exploit the anonymity possible on the internet to engage in fraud without ever setting a foot anywhere near Scandinavia. But they can have real impact on Scandinavian citizens, as we'll see. So let's now, with that long introduction, take a tour of international manipulation. And I want to start with what I'll call the ABCs of manipulation. The most well-known kind of fraud in the United States is called the pump and dump scheme. And all prosecutors know it by heart, and it gets regularly caught, detected, caught, and prosecuted successfully. Usually there are two steps: constrict the supply, and two, stimulate demand. You constrict the supply typically by focusing on a fairly new company that's recently had its initial public offering and is traded in a fairly thin lower level of NASDAQ or simply over the counter. And the brokers who worked on that IPO know where the stock is, probably represent clients holding a majority of the stock. And they get together and they can agree, we're going to constrict supply, meaning we're not going to process client orders. We're going to hold down those client orders for a week or more. We're simply not going to do what they tell us to do. Tell them there was no market available today, something like that. But the idea is to hold back the supply. And then you stimulate demand by spreading false positive rumors. With little stock out there, the few purchases that you get has a real price impact. The stock goes up, keeps on going up, and then you dump all that overhanging supply as fast as you can into it, and you will probably be able to eliminate your holdings at a substantial profit. That at least is the classic pump and dump, and it works often enough that it is frequently engaged in. Now that's the old style. Here are the new style of manipulation. And the new style of manipulation involves, first of all, manipulating not individual stocks, but indexes and cryptocurrencies. They are much bigger. They're a little harder to get the stock to move up, but once you get them up, you can dump a huge amount into that market, and we're talking about tens of millions in a daily profit rather than hundreds of thousands of dollars in a daily profit. Okay, and now, rather than doing the classic pump and dump, which is spreading false positive news, you now are going to spread false negative news, having first purchased put options. The limitation of this kind of manipulation is to companies that are at least big enough that some dealer out there is trading put options in them. And at the risk of insulting you, let me just remind you that a put option gives you a contractual right to sell the stock at the price of the option for a period of time. So you have the right to sell high and later buy low if you can drive the price down. That's the first step. I'll call this kind of manipulation not a pump and dump, but rather a dump and pump. You are going to dump the stock. You're going to have the put option giving you the right to sell. You're going to press the stock down with negative information. And then comes the second step that I'll hold a bit, just so this is what the beauty of this. You can profit both ways in the dump and pump, not just on the downside. Okay. Now, let's take example one. Example one is a well-known index. It's called the VIX. It's issued by the Chicago Board Options Exchange, which is the largest options trading market, and it's called formally the Volatility Index. It's actually referred to by the press as the fear gauge. But the fear gauge is trying to measure the amount of investor fear out there by looking at distance between option prices and the underlying security prices. Okay, and the fear gauge is much followed. And of course, you can trade on it. You can, various markets will produce you the ability to trade through puts and calls on that. In a 2017 working paper by two financial economists, Griffin and Shams, they're both at the University of Texas, they've become quite well known, they find strong evidence that at the time of the monthly VIX settlement, just before the monthly settlement, so it's like 2 days a month, there is unusual trading and very high volume spikes in the underlying S&P 500 index options, but only in those options that are included in the VIX, only the out-of-the-money options in VIX stocks. Let's suppose there are 50 VIX stocks, and 48 of them have traded options on it, and you're going to find a spike just in those 48. Another 100 stocks have totally level trading, even though they're in the same industry and are otherwise similar. Now, these authors then go through the bulk of their paper, doing what economists always do, a little bit of insult here, which is studying and rejecting all other alternative explanations for the same phenomena. And they say no other explanation for why there are these spikes in just the VIX index options really holds any water. And then they come down to a conclusion that the distortionary costs of this trading exceeded $1.81 billion over 7 years. But it's growing. And right now there are a number of private class actions. I don't think they've gotten very far. And there are allegations but no confirmation that the government has begun some kind of a criminal investigation, but it hasn't gotten very far. Now, so far you may be saying, well, that's one of those strange stories from America where they have exotic and corrupt people doing all kinds of sordid activities. It doesn't affect us. Well, wrong, because the same authors did a quick examination of the European Volatility Index. Yes, there is a European Volatility Index. It's called the VSTOXX, and it seems to have the same pattern associated with its settlements. And the generalization I will make, not fully supported yet, but still a generalization that I suspect will prove to be true on closer examination, fraud gets exported. Fraud is done by fraudsters who are quite entrepreneurial, and they can go abroad. If it works in the US, it'll work in Europe, and they have exported this kind of VIX index manipulation to Europe as well, where someone is losing. And again, I'm only looking at the cost to immediate investors. Getting these indexes wrong may have all kinds of economic allocation costs that economists can debate on their own. Okay, none of this should surprise us. If you can manipulate a US index, you can manipulate other indexes, and I think you have to expect whatever works in one country has a good chance of working elsewhere. Okay, so we have at the present time no public actions with respect to this, so there may be an investigation. Lots of class actions, but they're still at an early stage. Now let me move to the main story. We're talking about small time stuff here. Now let's go, if with a little help from, now let's go to cryptocurrencies. Whatever is happening with respect to indexes is dwarfed by manipulative trading in cryptocurrencies. About 10 days ago, the Wall Street Journal reports that dozens of trading groups are manipulating the price of cryptocurrencies. This was a long study. They worked a month or two on before releasing this. Are manipulating the price of cryptocurrencies on some of the largest exchanges. Now, these are currency exchanges, cryptocurrency exchanges. They're basically unregulated. They are basically offshore. They're not really in the United States. And they generated at least $825 million in trading over the last 6 months, a minimum number of $825 million in trading of cryptocurrencies on these unregulated offshore exchanges. What's fascinating about this, I love brazen fraud, and this is the most brazen fraud I can point you to, is that some groups use a name that explicitly communicates their purpose being to manipulate. They use the word pump because pump is absolutely well known what it means in the United States. And so the biggest of these is a website called Big Pump Signal. Well, that tells you where they're going, and they have 74,000 followers or subscribers. A lot of people at least want to see what they are saying. And this year, according to the Wall Street Journal, it is already promoted. We're only, half done. Already promoted 26 pumps that involve 222 million in trades. Now, if you just divide that, that's going to come to something like almost $10 million, well, under $99 million per pump. And maybe it ranges between 2 million and 20 million. But you can invest that kind of money and still really move the much more larger cryptocurrency because it's volatile, and concerted pressure on one day will really move that cryptocurrency. The technology is beautifully simple. An anonymous group leader, and this anonymous group leader better stay anonymous because he's a great target for, he or she is a great target for criminal prosecution. You will know that on this particular website, I used the term Big Pump Signal. The second largest is called Mega Pump, and the third largest is called Orion Pump, Orion after the star. So they all want to know, what they're doing. The technology is simple. the anonymous group leader will announce that he's going to tell you at a given time later that week, maybe 2 days later, what the target will be for this week's big pump. And so at a set time, say 8 a.m., they will put out a signal and say, today we're going to target and pump up, I'll use the term, Tether, or it could be something, probably not Bitcoin. That's too big to easily pump. It might be Ether. There's several hundred of these now, and they'll look at what they think might be the most inviting target. And then all the participants buy like mad from 8:01 on, okay? And the currency soars for a few hours. Now, the problem with this is there is no signal of when the pump is going to end. And generally, those who are risk averse and only pump for an hour do better than those who think they can keep on going for 3 hours. And then you see the recriminations fly. The journal was very good in showing that people who actually stayed in for 3 hours until it went down were screaming bloody murder, saying, why didn't you keep it going? And getting back the response from their fellow fraudsters. Too slow, bro. Too slow, bro is the statement you give to someone who didn't get out quick enough. But at least for an hour or two, the price goes up. And so what we see again and again is this wild roller coaster ride repeated over and over. You think people would get out of this. No, somebody is making money and someone else believes the story that blockchain is the wave of the future. It may be, but the phrase I'm going to remind you again and again with is historically. Fraud and innovation go hand in hand, and the biggest innovations often have the biggest frauds. We saw this in the US with the world of the internet, and when the internet bubble burst in 2001, there were extraordinary things that were being said they were doing on the internet, but they weren't coming close. There was no reality to their description. Okay, now, so far I've just talked about this kind of collective group pump. And the key actor here is an anonymous moderator who acts like a cheerleader, getting everybody to follow her or his cheers as they say, bye, bye, bye. Okay. Now let's move to a far larger kind of fraud, and this is intercurrency arbitrage. And again, the economists Griffin and Shams, in a relatively new paper, find that Tether, a new and little-known currency, that in theory has been pegged to the value of the US dollar, has been used to support and manipulate a much larger currency, Bitcoin. Bitcoin has a number of billionaire investors that are very strongly interested in maintaining and stabilizing the price of Bitcoin. And at various times when Bitcoin has started to collapse, the collapse has been averted, or at least the price decline has been cut off, when a substantial amount of trading occurred on these intercurrency exchanges. And typically, Tether was used to buy Bitcoin. On the intercurrency exchange, you can take Tether currency, Tether coins, and use them to buy Bitcoin coins. Why does that work? The puzzle here is that why should a very little-known currency with 1/10 the volume be able to support a much larger currency when nervous investors are likely to panic? They've had plenty of reason in the past to believe they could panic. The answer Griffin and Shams suggest is that Tether purports to be backed by dollar reserves in an amount equal to the outstanding number of Tether coins. Now that's quite a claim. It says we've got dollar reserves equal to the outstanding amount of our currency. Thus, they suggest, the purchase of Bitcoin with Tether reassures investors as it seems to be a real cash point purchase of Bitcoin at its face value, or at least the current market value. That's reassuring. But does Tether really have these dollar reserves? Oh, that's always the problem with fraud. There's always some detail that isn't verified. Okay, Grimm and Shams express great skepticism. By the way, they wrote their paper in June. Since they published that paper in June, I assume most of you know what SSRN is. It's sort of the lingua franca of academics these days. This paper in 2 months has received over 23,000 downloads. For most academics, that's more than a career's worth of downloads on SSRN. So it's gotten a great deal of attention. But the really interesting developments are since their paper came out, Tether realized that they were in danger, they had to do something, so they announced they were going to hire an auditor to audit their dollar reserves. And they did, and they announced the name of the auditor. Several weeks ago, Tether announced that it had fired its auditor for unstated reasons, and the auditor refuses to comment. This looks like the last days of Bernie Madoff to me. I mean, there's something really going on here. And now, further, last and maybe most suspicious of all, most of the trading in Tether occurs on a basically unknown, unregulated exchange called Bitfinex. Bitfinex, all right? Who owns this unregulated exchange? Answer, the people who control Tether. Self-dealing. It tends to sneak its way into most stories like this. So we have still unraveling fraud. By the way, I do think we're going to see more of these because as cryptocurrencies become more and more attacked, I think they're going to have to become involved with and hire gatekeepers of various sorts to give them greater credibility. And of course, gatekeepers can also be manipulated. That's one of my favorite topics also, but we won't go into the gatekeeper side of this unless you have further questions. I just expect that they haven't used gatekeepers to date, but as they come under greater attack, they're going to need greater credibility, and I think we'll see gatekeepers enter the story. All right, now let's see if we can again, okay. Overview. The current status of cryptocurrencies resembles the American West in 1870, or perhaps an episode from Game of Thrones. Does Game of Thrones play in Scandinavia? Looks like it was set here. I mean, I assume it's all the background. It looks like it's in Iceland or someplace. All right, part of the problem, of course, here is that the U.S. agencies, neither the SEC nor the CFTC, the Commodities Futures Trading Commission, claim jurisdiction over cash markets and cryptocurrency. So this is an unregulated world. Okay, where only the instincts of entrepreneurs to be fair and honest restrain them. And those instincts may be fairly modest. All right, the entrepreneurs inventing new cryptocurrencies have gravitated to remote and dark corners of the world. Malta, Gibraltar, the Zug Valley of Switzerland. In these places, they're promising employment. If you're in Malta, here's the only people who ever shown up and want to bring in jobs, corporate headquarters, and all they want is you to give them limited liability for the Bitcoin chain. They want blockchains to be treated as legal persons and get limited liability just like a corporation. It's an interesting concept. I don't know where the rest of the world will buy this, but I think the rest of the world is more interested in criminal prosecution than going through and piercing the veil. All right. The losses from cryptocurrencies this year have been extraordinary. Now, the New York Times reported on August 20th, about the day before I mailed in these PowerPoint slides, that the value of outstanding digital tokens has fallen by about 600 billion or 75% since the peak in January. And this is not US-based fraud because the SEC is so extremely suspicious of initial coin offerings, they almost all get done offshore and not in the US. And the exchanges are also typically outside of the US as well because no one wants to mess with an SEC, which is very Victorian about fraud. They don't like it. Okay, the largest losses seem to have been in Asia, South Korea, and Japan. Now, defenders assert that blockchain is the most important technological innovation in decades. They could be right. I'm not saying that I know that's wrong. But fraud and innovation, again, go hand in hand, as the internet bubble in 2001 showed. All right. Now, next to last category, the reverse dump and pump. I talked about this earlier, but let's go through the actual technique. Once fraudsters released positive information to drive up a stock's price, and then they dumped their previously acquired shares into it. That was constrained by the fact you had to actually own the shares. That's very old-fashioned today. The new scheme is to first buy put options, which, as I said, gives you the right to sell at the existing price, but more importantly, it gives you great leverage. For the same amount of dollars, you can get 10 times the equity exposure with options as you can with stock. And then they post false and very negative information anonymously on new websites that permit anonymous posts. Now, I'm not attacking all of these websites. They are very popular. The best known one is Seeking Alpha. Anyone here heard of Seeking Alpha? It's okay. Some people have heard of it. You'll get gets a lot of attention in the U.S. and they'll have lots of anonymous posts, both positive and negative, and they make no effort to monitor. They say they can't. How can we trace 1,000? And they claim First Amendment privilege. There is in the U.S. a strong First Amendment law that lets you make anonymous statements. Okay. Now, often the anonymous source will pose as a whistleblower. They'll use an anonymous name, the whistleblower, market guru, the insider, all suggesting they know something, and particularly that they're a whistleblower because they get a little bit more credibility. They can tell you really extraordinary false information, such as we have just learned that the CEO of Widget Corp has entered a rehab clinic for cocaine addiction, will be there for 30 days. That's totally false, but it has an immediate market impact on the price, and it's anonymous. Of course, once you use this under that name, your credibility will eventually will quickly be totally forfeited. But all you do is switch to a new anonymous name, and the only real limit is how quick you are coming up with new anonymous names, okay? And some of them are quick enough, all right? And so it doesn't have to be cocaine addiction. It could be the auditor has just resigned and the company refuses to disclose why. That'll also get a market impact, okay? Or the SEC has just subpoenaed, and a grand jury has just subpoenaed all the senior officers to come in and talk about price fixing in their industry. All those things will get this immediate market impact. The fraudsters know that this information will get corrected quickly, maybe within a day and a half. The company doesn't learn about it for 5 or 6 hours, perhaps, and then they call their lawyers and come up with statements to see how they can prove that the CEO is not in a cocaine clinic or that the auditor has not resigned or whatever. The fraudsters know that eventually this will get corrected. And let's suppose they do this at 2 o'clock in the afternoon with 2.5 more hours of trading, and the market goes down. And they exercise their put options overnight, and the next morning there's a correction. The next morning, they've already in advance bought call options. And the great beauty of this is they can profit both ways. If they've got the market price to go down, they capture that with a put option. Overnight, they buy the call option, it gets corrected and goes back up, and they get a two-way profit and the great advantage of using high leverage through put and call options. Much better than having to actually buy the stock and only getting the upside of the price. Okay, now how common is this activity? My colleague and friend at Columbia Law School, Joshua Mitz, who's a law professor, but he also has a PhD in finance. We tolerate a little of that on our law faculty. He counted, and he's found there have been 1,720 such anonymous attacks via the internet between 2010 and 2017. And it's a growing number. And this tends to focus on smaller companies, and they are very bitter about it. They've tried to sue, but they keep running into this common problem, namely that courts, generally they get sued for defamation, because the company didn't purchase or sell securities and doesn't have standing to sue for securities fraud. But they sue for defamation, and they can't get the site Seeking Alpha to disclose. They are privileged under the First Amendment to deny the identity of the people who posted with them. Therefore, private litigation is not working. There is a possibility that the SEC should be able to sue, and I'll discuss a strategy later, but the SEC has not yet done this. They also are concerned about the First Amendment limitations. All right, all that limits these fraudsters is thinking of a new name, and I give you some of the names that are popular. Okay, now, last category, maybe it's a little bit more mild. Hedge fund activism, a very big topic. Today in the United States, hedge funds have replaced the hostile takeover. You see very, very few hostile takeovers. What you instead see is hedge funds identifying a target that they believe is underperforming. One of them will buy a block of stock, usually just over 5%. At 5%, you are required to make a requisite disclosure called Schedule 13D and announce, among other things, what your plans are. And you want that requirement because now you disclose our plans are we want to sell off the lackluster division that management refuses to sell. We want to leverage the company much, much higher. We want to take the proceeds of that leveraging and buy back a third of the stock. All of these things produce, on average, an abnormal gain on that first day of 8%. That alone is making you a good first day profit. And then the next demand you make is for board representation. You may say that you want 3 or 4 seats. On average, you settle for 2 seats. Management doesn't really dare resist because they don't know how big you are. They know you have 8%, but you may have around you a hidden pack, a so-called wolf pack of allies who have purchased maybe 15% among themselves, and you may own a quarter of the stock, meaning that the remaining 3/4 of the stock, management only owns 5%, and it's going to get a majority, a vast majority, 2/3 of that remaining 70% if they are going to be able to beat you. And so they sell because they're risk averse, and they give you 2 seats on the board. And that's where I get interested. I'm not going to debate hedge fund activism. It gets debated endlessly between the people who believe there's short-term biases and people who say the market doesn't have a short-term bias. That debate will go on. Happy to join in too, but right now I just want to focus on what happens once this activist hedge fund gets 2 directors on the board. And we find a dramatic shift in terms of what we call information leakage. Once the hedge fund appoints representatives to the board, the market begins to anticipate further public disclosures by that hedge fund. Whether they're good or they're bad, the market knows about them in advance, and the market price moves halfway up to what the new disclosure will cause before it occurs, so just a few days beforehand. More importantly, well, there are three remaining facts I want to stress about this. First, the trading with regard to this kind of hedge fund activists on the board is almost principally occurring, at least in the options market. Again, the people who are trading are exactly informed traders who prefer to go at low cost into the options market. Next, more importantly, the people doing this, though the market differentiates dramatically between hedge fund nominees to the board who are former retired industry executives. Often hedge fund activists will find a former well-known CEO and he wants to play statesman, captain of industry, and he may have ideas of what they're doing wrong, and they appoint him to the board. Market doesn't respond much to that, okay? Or they may appoint as part of the team a hedge fund employee. When they appoint a hedge fund employee, the amount of information leakage is more than twice as high as when they simply appoint an industry retired executive. Industry retired executives appear to maintain confidentiality. Hedge fund employees, I can't say that they're trading. We don't know who's trading, but the trading goes up dramatically when a hedge fund employee goes on the board. Next point, the market anticipates this. When the hedge fund nominees go on the board, the bid-ask spread widens significantly, suggesting what? Suggesting that's a classic signal that the dealers expect informed trading is coming, and so they are widening the bid-ask spread. So we see widened spreads, a huge difference between hedge fund employees and what I'll call retired captains of industry who give credibility. The market, by the way, while it goes up very happily, significantly, on the announcement of the 13D and the fact that there's going to be a campaign for this somewhat lackluster company, the market goes down when you disclose an appointment of a hedge fund employee. The market anticipates something's going to happen that isn't going to necessarily good for the other shareholders. Not greatly, but there is a negative reaction. Okay, we can't tell you who's doing the trading. It could be the new director. I doubt that because he's got to disclose his trades if he's going to be in compliance with the law. The hedge fund, I doubt that because they may have to disclose it as well. Or their tippees. My most cynical interpretation, I have a variety of cynical interpretations, but the most extreme, and I don't have dispositive evidence for this is a way you hold together the wolf pack. The wolf pack knows they're going to get a great deal of profit when they file the 13D. So they know in advance, they buy the stock in advance, and they get an 8% abnormal return. Nothing else tends to happen to the stock unless there eventually is a merger or a takeover. And those tend to be not common. There aren't that many, even though the hedge fund would love it, there aren't those many of those, okay? But the possibility here is that the other members of the wolf pack stay around because they're assured of a continuing flow of information from the hedge fund telling them good or bad news, so they get this abnormal return from informed trading. Can't prove that, that's speculative. All I can say is there is informed trading and someone's profiting, and it would be in the interest of the lead hedge fund to tip members of the wolf pack because they need to hold a voting majority. They need to hold a big voting block together to have leverage, and they can do that if they're giving them something. What this also means, too, is that hedge fund activism, whether it's good or bad, is receiving a kind of perverse subsidy. The perverse subsidy is here. You know, I have no objection that the hedge fund makes money because they announce a business plan, start moving towards it, and the market price goes up. Okay, they're doing the Lord's work, keeping the market efficient. At least that interpretation is there. But if they are not doing anything, and the market even went down on their announcement of their plans, they may still get a large profit from being able to engage in informed trading, and that's a subsidy to activism that may be perverse and may make even a bad intervention profitable, so that you are facing really a no-lose. Heads I win, tails I break even. And I suggest to you that anytime you get a heads I win, tails I break even investment opportunity, you probably should take it, and that maybe there of informed trading is possible. So that's the world of hedge fund trading. Can this be detected? Now, there has been no attempt by the SEC to go after these, although they are concerned. The possibility is fairly easy to detect because this trading is occurring in the options market. The SEC can go to the dealers. The dealers are always angry. They know that someone bought 25,000 options yesterday, and this morning they announced this big news, all right? They're angry. They can tell the SEC, all we know is that order was placed by Merrill Lynch. But the SEC can go to Merrill Lynch and say, who are you trading for? And Merrill Lynch will answer the SEC within hours. They aren't going to resist the SEC. So here you can get pretty good enforcement, but we haven't yet seen the SEC pursue any of these. It's controversial. I'm trying to get this to go forward. Okay, implications. Now, there are a number of implications here. Let me, well, maybe I should say, I'm seeing what else have I missed here. So let me go to implications. I've been suggesting that a number of markets today are significantly rigged, particularly in indexes and currencies. And they appear to be rigged on a global scale because most of this trading is occurring on exchanges that are unregulated and outside of the US. Now, not many years ago, we saw a similar pattern in LIBOR and Euribor, where it was essentially done by an old boys club of experienced traders. They were first trading in London, and they eventually moved over and did the same thing in the yen in Japan. By the same people, because you can trade yen LIBOR, or the equivalent of yen LIBOR, through London markets on indexes. Okay, now that's the old boys club, and there were some prosecutions. Some people did get convicted, although most of them got acquitted. The British are not very good at convicting people for manipulation. Now we're seeing this new behavior being done more on the internet, where you can exploit the anonymity of the internet, either to manipulate currencies, indexes, or to engage in concerted efforts to pump and dump, or in my phrase, dump and pump. Large groups assemble with the sole purpose of moving a cryptocurrency for a limited time period. The losses have been global. And now to make just one local Scandinavian reference again, the losses here vastly dwarf even the losses of famous crooks like the US's Bernie Madoff, and to throw in one Swedish reference, maybe even Sweden's match king, Ivan Kreuger. I don't know how he's regarded here. I'm not even sure his losses were that great, but I wanted to give you some local reference. This kind of trading is much larger than Bernie Madoff, who is probably the most extreme crook with his Ponzi scheme that went on for 30 years. Can this be stopped? Yes, but probably only on an international level by a strike force of cooperating agencies, because the perpetrators will usually hide in a dark and possibly captured country, Gibraltar, Malta, or wherever, trading on the internet. To stop this, one has to subject unregulated exchanges to some agency's jurisdiction, so that there are some controls on what gets traded and some records as to who is doing the trading. Then and only then can the enforcer induce the exchange to disclose who was behind suspicious trades, which is what the SEC can do very successfully if they have the broker within their jurisdiction. It will disclose who was trading. And they've caught people doing insider trading in China because they used an affiliate of an American broker. All right, now what could be done? An initial step might be that brokers and investment advisors in a jurisdiction, hypothetically Sweden, may need to be restrained or prohibited from sending customers' orders to unregulated exchanges. That kind of prohibition, prophylactic rule, might cause the exchange to register with those jurisdictions and be subject to greater supervision. Once you get the exchange subject to regulation, you can start finding out who is trading. And my guess is, although there might be two steps in between, that a lot of those traders will come back to major financial centers in Singapore, London, New York, etc. Okay. Possibly, too, legislation is needed. This is a topic I plan to raise with IOSCO at their conference in Luxembourg in early October, that too much of the world doesn't have cryptocurrency trading within the scope of any existing regulatory agency. Yes, it might be a criminal fraud, but the existing regulatory agency, whether it's the SEC or the British FCA, they have more experience with manipulation, what defines it, and more ability to respond quickly on a civil basis to suspicious trading. So I think there are things that can be done. I could suggest some more, maybe later if there are questions. For the present, I want to tell you that I can think today the problem is more likely to get worse before it gets better. Now, I promise to give you 10 more minutes, which means I have 2 more minutes to make one more little plea. I think when we talk about regulation and enforcement, there is insufficient recognition. We're talking about 2 very different cultures. If I were to draw 2 Venn diagrams up on this board, one is a Venn diagram of all of the world's securities regulators, and on the other, all of the world's securities enforcers. The overlap in terms of their educational and experience background would be about 1%. These circles would just barely be tangential overlap. That's because enforcers around the world tend to be trial lawyers who know how to prove something in court. And regulators, maybe they're lawyers, maybe they're economists, they've never gone near a courtroom. They tend to be interested in the economics, or at least the very long history of legal regulation. At the SEC, the people in corporate finance division or the trading and market division are not actual lawyers with trial experience. Those people are over in the enforcement division. And the culture between the enforcement division and, say, the corporate finance division, very different. They don't talk very much the same language. There needs to be greater communication at an earlier stage. The enforcers know what you can possibly prove in court, and they will reject many of the enforcement requests they get from the other divisions of the agency because they know you just can't prove that. That's not evidence. That's not admissible, and it doesn't prove anything, and a judge will reject it, and we will be embarrassed. Enforcers don't like to be embarrassed. Okay. Conversely, the regulators will say, all you have there is suspicion, and we're worried we're going to chill really desirable communication as well. We don't want to stop all the world's cryptocurrencies by doing this. So you have a culture gap, an educational gap, and I think there has to be an effort to try to get both thinking along the same path, which probably has to be done on an agency by agency basis. Okay, I'm now at 10 minutes of my allotted time left, and why don't I turn it over to questions? I think I've given a huge target for the panel to pick on, but let's see.